This is FRM Part 2, Book 2, Credit Risk Measurement and Management, and the chapter on capital structure in banks. Before we get to the slide deck regarding capital structure in banks, let's just do a quick review on capital structure. This is the right-hand side of the balance sheet for businesses in which a business raises capital by issuing bonds or issuing shares of stock to finance an investment in positive net present value projects. A lot of people think of the right-hand side of the balance sheet as the sources of capital, right? Debt and equity. Well, banks are no different. Of course, banks issue bonds, and many of them are publicly held, so they issue shares of stock. But the top right portion of the capital structure of the balance sheet is what makes banks, fairly unique because they have lots and lots of short-term liabilities. For example, if you hit the Pennsylvania Powerball lottery for $400 million and you get a check for $220 million, you go into the bank and you can deposit that, right? And let's just suppose you, for argument's sake, you put it into a regular old savings account or a checking account. The bank has all this money one day, and so it might say, oh, look, I can lend this $220 million to all these people who want car loans and mortgage loans and personal loans. But let's suppose the very next day you go back to the bank and say, hey, I want my $220 million back. And the bank looks at you and says, well, wait a minute, we just lend it to all these people over here. So you get the sense that capital structure in banks is pretty unique. And that's what these learning objectives kind of suggest. So we're gonna look at economic capital, and then we're going to identify some terms like a probability of default and exposure and loss rate, expected and unexpected losses. Notice we still have probabilities of default in there. And then, of course, we're going to try to quantify and look at the challenges to quantifying this credit risk. All right, so let's get started with some, just some basic introduction and some terminology here. Credit risk describes the risk that arises from non-payment, right? So what does a financial institution do? It makes business loans, it makes car loans, it makes real estate loans, and what does the borrower do? The borrower says, I promise to pay interest and I promise to pay principal. What that means then is that the credit risk depends on the borrower's ability to repay that loan. Now, of course, there is this concept of credit migration in which the financial fortunes of the borrower changes over time. If I go to the financial institution and I, borrow $10,000 or $20,000 for a week, my financial situation is probably not going to change over a week's time. But if I say I want this money over 50 years, boy, who knows what's going to happen to me over the next 50 years. All sorts of really good things could happen, so that if I hit that Pennsylvania Powerball, then my loan of, what did I say, $10,000 or $20,000, that becomes kind of a non-event. But if I lose my job, or if I become disabled, or if I happen to die, or this migration can occur in a positive sense or a negative sense. The expected loss is the amount a bank can expect to lose on average. This is important, on average over a certain time period, like a week or a month or a year, when extending credit to all the borrowers out there. But what we've got to do is differentiate between expected loss and the unexpected loss. The bank can look at me and say, you know what, I think that on average, if I lent to 100 people that look just like Jim, I might lose $100 or something like that. But what is that standard deviation? What is that volatility? Remember, even though there might be 100 people that look a little bit like me, or maybe a lot like me, they're not going to be exactly like me, and their fortunes are going to change different than my fortunes over time. So that unexpected loss is the volatility of those credit losses around the expected value. So once these expected losses and unexpected losses are determined, then what the bank has to do is say, okay, all right, okay, Jim, you just deposited $220 million. Let's go ahead and figure this out. We need to set aside some of that. Okay, so those things are called credit reserves. And then the definition of economic capital, I have it written right there, estimate of the overall capital reserve needed to guarantee the solvency of the bank for a given confidence level. And of course, we've talked about distributions and confidence levels and alphas and betas here. And so, I mean, a financial institution could say, you know what, I would just like to have a 50% confidence that Jim is going to repay his loan. Of course, 50% is probably not going to do it. That's why we get all the way up to, 95 or 99 or 99.5 or something like that. What happens then, this confidence level is pretty much set based on what the bank wants as its target credit rating. I mean, a financial institution is never going to say, hey, you know what, give me a C credit rating and I'll just lend to everybody with a C credit rating, and then I'll probably not recover most of those, and that can't be good news for the long term. So economic capital determined by level of confidence and then the level of risk. I explained those. Let's get some definitions here. Probability of default, the probability that a borrower will default before the end of a predetermined period. Okay, that makes sense. Exposure amount is the loss exposure at the time of the loan's default. Of course, that's a dynamic amount. It keeps changing. Hopefully, it keeps falling because the borrower makes principal payments. And then the loss rate is defined as 1 minus the recovery rate. Let me just give a quick example here. I love to give personal examples, so you guys probably know that I have a son in college, and so if he came to me and said, "Hey, Dad, I need $10,000 to go do something with it," and I said, "Sure, son. Here's $10,000. I'll charge you 0.5% interest because I love you so much." Now, since he's in college, he doesn't have a job, and so he still has several years to go in college, so he's probably not going to have a job anytime soon. So his probability of default it's probably 100%. Now the recovery rate, he doesn't have any assets, right? He doesn't have a house, he doesn't have a car, et cetera, et cetera. So the recovery rate is probably 0. All right. Now compare that to my older daughter who has a great job and she's pretty stable and all that kind of stuff. Her probability of default might be 1% or 0.5%. And then she has a house, she has a car, she has some savings and money, and she invests in mutual funds, as you could imagine a daughter of mine might. And so her recovery rate is probably pretty high. So what I want to do is go to the next slide here so you can understand the calculation of this expected loss. All we're going to do is multiply those three. Here, let me go back really quickly. All we're going to do is multiply those three together to get the expected loss. So for my son, let's go back here. What was that? Probability of default, 100%. What did he borrow for me? 10,000. So 100% of 10,000 is 10,000. Recovery rate is 0. So the loss given default is going to be the $10,000, right? That should make perfect sense. My daughter, on the other hand, what was her? Whoops, let me go back here. What was her probability of default? Probably 0.5% or 1%. There's the same 10,000, but the recovery rate is much higher. So the expected loss on that loan might be, $100 or $50 or something like that. Now, of course, financial institutions, they're not going to lend to my son and my daughter, but they're going to lend to businesses and individuals and all different kinds of people out there. And so people and businesses. So these expected losses, it's a relatively easy calculation. Of course, they fluctuate from year to year. And we can use statistics to try to estimate these things. Now, remember I said a few slides ago, this unexpected loss is going to be some deviation from the expected loss. So unexpected loss is the average total loss over and above the expected loss. It's the variation. And so, of course, you should be thinking that we're going to use standard deviation as our measure of volatility. And so there's a good formula for you to know. Unexpected loss, we need inside of the square root sign that probability of default times the variance of the loss rate, and then we need the loss rate, and then we need the variance in the probability of default. So if we go back here to do all that, we're going to need these same inputs that we use to calculate the expected loss. We're going to use those to calculate the unexpected loss. And so note, it's important that the volatility of the probability of default is a Bernoulli variable with a binomial distribution. Remember this dude, Jacob Bernoulli, lived in the late 1700s, and he was one of the first guys to say something like, oh, you know what? If I flip a coin, I get this number. If I flip a coin and it goes the other way, I get this number, and I can only get those two numbers, right? So he said, oh, there's a 1 and there's a 0, and so that distribution then can go from 0 to 1. So this is really a distribution in which you either have, kind of like a success or a failure. Now we quickly did these examples with my son and daughter. Let's do a real live example here. So this might be something that shows up on an exam. $2 million loan, 1.6 is currently outstanding. Of course, what does that mean? That this borrower has paid $400,000 over the time of the outstanding loan, right? So the borrower has a 1% chance of defaulting, loss rate of 30%, and so there are some standard deviations of the probability of default and the loss rate, 6 and 20%. So the expected loss, we do this just like we did for my son and daughter. So on a $1.6 million loan, we have a pretty small expected loss, and we're going to have a little bit higher unexpected loss because we're going to have some volatility. And so if you put all those numbers in there, you get about $43,000 for the unexpected loss. Now, of course, that example was just for one borrower, but financial institutions are going to have multiple borrowers, and so that expected loss is going to be additive. So all the financial institution has to do is take the expected loss here, take the expected loss here, take the expected loss here from that whole range of borrowers, and then sum those. But of course, the unexpected loss is not quite that simple for the reason that I'm going to explain now. How about if this happens? Suppose that my son, who cannot pay the loan, just announces that he's not going to pay the loan. Hey, Dad, you know what? I'm mad at you for whatever reason. I'm not repaying this loan. And my daughter and my son talk, and my daughter says, you know what? I'm mad at Dad too. I'm not repaying this loan. So her repayment, right, her ability and willingness to repay depended on her conversation that she had with my son. So there's going to be some correlations. And of course, this makes perfect sense. If you have two businesses, inside of a city or a county, and there's some economic stress in this area, if one suffers a loss and decides not to repay the loan, then the other is probably exposed to the same economic conditions, and so there's going to be correlation in there. And that's why the formula there in the middle of the page for the two asset portfolio, I mean, we've seen this before, but if you look over on the right-hand side, it's 2 times the correlation coefficient between loan I and loan J, and it's 2 times. Remember this explanation because I covaries with J and J covaries with I, so you have to count it twice. How about risk contributions here? Risk contribution of a risky asset to the unexpected portfolio loss is the incremental risk. And this is one thing that I teach in all my classes, whether it's corporate finance or investments or derivatives, is that when evaluating risk, you have to do it incrementally. That's why in capital budgeting, we always do the incremental cash flows, the cash flows that are at the next level based on the decision. I want it like that. It could also go like that as well. All right, so this is called the unexpected loss contribution, and the portfolio unexpected loss contribution can be broken into some components the unexpected loss contribution of asset 1, and then asset 2, and then asset 3. And then what we can do is we can use our knowledge of mathematics and calculus to kind of measure sensitivities. And that's what that bottom formula looks like down there, that bottom equation. The unexpected loss contribution of loan I is the unexpected loss of loan I times a partial derivative. So think of that as the sensitivities of changes in loan I versus the entire portfolio. So here's a more general version of this formula. And so notice that up in that numerator, there is the correlation coefficient between I and J as well. Now, if we bring that down to just 2-asset portfolio, then that formula, that equation right there, then simplifies to this thing right here. And so what you can do is you're going to get the contribution of each asset using those two formulas. And then you can add the ULC from the first asset to the ULC of the second asset. And so what that does is that gives you the unexpected loss contribution for the 2-asset portfolio. Now, of course, financial institutions, they might lend to hundreds or thousands or, I don't know, tens of thousands of people. And so what happens is that in a group of loans, that the characteristics of the borrowers tend to be similar, right? So if they have approximately the same characteristics, and this goes back to what I was saying earlier, if the financial institution lends to 100 people that kind of look like me, then what we can do is just make that correlation constant. Now, here's the learning objective about this economic capital and how it is derived. Remember, it's the amount of capital needed to keep the financial institution solvent, which means that the economic capital must be matched to the bank's unexpected losses. And so if you look up, if you do a search for economic capital and look for pictures, they always give it to you this way here. So the distribution goes like that. And really all we're going to do is take the difference between the unexpected outcome and the expected outcome for a given level of alpha. Of course, a given level of alpha, which for 50% would be very, very different than from 95%. But what the chapter does, and I think this is a little bit more indicative of what's going on. Here, let me say this. If you look, almost all of the pictures show the loss going this way. And for me, it's a little bit difficult to think about losses that go out to the right, because I always think of capturing the right-hand tail of the distribution. That's a good thing when we're dealing with normal distributions. Of course, here it's a little bit different. And so what the textbook does is it puts the picture this way here. So this has the losses going to the left, and it looks a little bit more intuitive to me. Now, how do we derive this economic capital? So let's go ahead and define X as a random variable for a loss and Z as a percentage probability. All right, so what we want to do is we want to let V be the minimum economic capital needed to keep the bank solvent. So what we're doing is we're going to set Z, right, equal to the probability that a random variable for the loss is going to be less than that minimum economic capital needed. So the bank might say something like, hey, we have a desired rating, let's say a AA rating, and that gives us a 99.97% Z, right? It could be 99.2 or 99.99, whatever it is. But what happens, given that desired level of Z, then what we can do is determine that economic capital such that the economic capital is equal to the capital multiplier times the unexpected loss. Now the question then becomes, how do we model this credit loss distribution? And so remember that when I lend this $10,000 to my daughter, what's she going to do? She's going to repay me over 3 or 5 or however many years, right? She's going to pay me that $10,000 plus some interest. And let's just suppose that interest is $500. So what's the most I'm going to get? The most I'm going to get back is $10,500 because that's the legal and binding contract between the borrower and the lender. She's never going to come to me and say, hey, Dad, here's $50,000 because you were such a great dad and a great lender. But what's the most I can lose? I can lose that $10,000, right? Plus I'm going to lose the opportunity cost of all of those interest payments, right? And so note, that example is not a bell-shaped curve. So the normal distribution can't possibly be used for this, right? Credit losses will be highly skewed. Extreme losses can occur. And then the maximum gain is just that limited promise payment. So how can we model this distribution? And what we find is the beta distribution is pretty appropriate here. And there's the function in the blue box on the left. I would focus on the mean and the variance here. Let me give you a quick example. I like to give sports examples, and so even though football season is starting here soon, let's go ahead and talk about basketball. Let's suppose that we have a favorite basketball player like LeBron James, and what we're trying to do is estimate what his foul shooting percentage is going to be for the entire year, right? They play 82 games. Maybe LeBron plays 70 or 75 of those games. So what is going to be his foul shooting percentage during that time? Right? What are the extremes? I mean, he could miss every single foul shot, and so that would be 0%, or he could make every single foul shot. So that would be 100%, but we know it's going to be somewhere in the middle. And so what this beta distribution does is it allows us to adjust as we move through time. So what happens if LeBron makes his first foul shot? He goes 1 for 1. That's 100%, right? So are we going to then say, oh, LeBron is going to make every foul shot for the rest of the season? Now, as great of a basketball player as LeBron is, and he has improved his foul shooting in recent years, he's probably not going to make every one, right? So we can adjust through time with this beta distribution, because even if he makes his first 10, let's say, and he's still at 100%, we know that sooner or later he's going to miss. And we know sooner or later he's probably going to miss 10 in a row, right? So there's this changing in the quality of LeBron's foul shooting ability over the course of the season. So look at that mean there. Suppose that we think LeBron is going to make 90% of his foul shots this year, right? So alpha, let's define that as 90, and then 90 plus a beta of 10, right? So 90 over 90 plus 10, that gives us the mean of 90%. And then the variance there is, pretty standard variance formula. And so that's fairly interesting, of course, for LeBron and foul shooting. What we're trying to do is model that foul shooting percentage, which is going to be close to 100%. But we're going in just the opposite direction, of course, for credit losses. If 90% of the people that we lent money to defaulted, then we wouldn't be in business for very long, right? So the alpha and the betas are going to be a little bit switched when we do this for modeling credit events. And then, of course, think about this. The Monte Carlo, we've talked about this at length, these computer algorithms are extremely handy, extremely helpful. Now remember, they have a lot of cost to them, but look, I mean, if we decided that we really wanted to figure out LeBron's foul shooting percentage or the credit risk of a particular type of a borrower, and then Monte Carlo is going to work really, really well. Now, of course, this is not just all science. If it were all science, then we probably wouldn't have had the financial crisis of 2008. There's some human element to it, some artistry, some opinions, and all that kind of stuff. And so, what happens here? What are some challenges to quantifying credit risk? We got to worry about credits are illiquid assets, right? I can't take my son or daughter's loan over to my best friend and say, hey, would you buy this loan from them? I mean, he might do it as a friendly gesture, but there's really no secondary market out there. This approach uses, pretty much a 1-year period, but of course, my son or daughter, they have this loan period of 3 or 5 years, right? So we need to identify these credit risk models that are able to be modified so that they can adjust to much longer periods. And the approach also segregates other types of risks, such as the operational risk and the market risk. So we're probably going to need additional resources to help manage those risks. All right, so this is this whole idea that I've been teaching you guys in all these chapters. We need to identify the risks, we need to quantify the risks, and then we need to manage these risks. And of course, that three-step process is not really linear. I mean, they're all related and they're all interrelated, and they change and they're dynamic over time. And that takes us through this chapter on capital structure.